companies. But the lone bright spot will be that cement demand has been reasonably supportive. Now, the street expects around 8 to around 10% year-on-year demand growth for the past quarter. Fallen commodity prices like steel, well, that helped demand recovery from the infrastructure sector during the quarter. That should further accelerate in the second half of this year. Now, Kotak expects 11% year-on-year growth in terms of volumes, which will be led by Shree Cement, Nuvoco, Dalmia, Ramco, as well as Ambuja Cements. They're all up for you on the screen. The problem was that cement prices were weak, as prices corrected by roughly around 4% on a quarter-on-quarter basis. Though it was monsoon season, well, this correction in terms of pricing was sharper than what we have seen in prior monsoon periods. The other reasons for pricing weakness is due to the rollback of the earlier hikes, as the government focus turned to curbing inflation after the price hikes were taken in April 2022. North, well, we saw the sharpest decline out there. There was a price correction to the tune of around 7 to around 8% on a sequential basis. However, the quarter ended on a positive note, as we saw some price increases towards the end of the quarter, particularly in the eastern part of the country. And higher input cost, well, that will result in a sharp knock-on margin. So two factors playing out: lower prices as well as higher input costs. Jefferies estimates that the industry unitary EBITDA will fall by around 350 rupees per ton sequentially in the past quarter. And from the top names, well, majority of the top line will be led by higher volumes, while the remainder will come in from higher prices. What stands out is the sharp contraction in margins that will be seen in all companies in the past quarter. This, as the high-cost raw material inventory will gradually get utilized. The second quarter FY23 is expected to be weak, so the street is bracing for it. But the hope is that quarter 3 FY23 EBITDA will improve big time, as petcoke prices, which constitute bulk of the fuel mix, well, that's corrected by around 20 to around 30% from its peak. Though thermal coal prices, well, they continue to remain elevated. Now, since it's post-monsoon, cement price hikes as well are likely to begin to take shape. Additionally, the street hopes that construction activity picks up. That will keep the off-take momentum going as well. Another benefit for the coming quarter will be that there is unlikely to be a volume push by ACC and Ambuja this time around. Remember, their closing for the year has been changed. Normally, it is in December. It's moved to March this after Adani took control. Finally, we leave you with a valuation chart of all the companies on an EV upon EBITDA basis. Back to you.
Okay, thanks a lot for that. Very helpful and thorough check on what to expect this time from the cement space. Rajesh Ravi, the institutional research analyst of the cement sector at HDFC Securities, joins us now. Rajesh, thanks a lot for joining in. You heard out what Nigel had to compile in terms of the cement sector. You tell us, what are the big things to watch this time around and which are the stocks on your radar?
Yeah, hi, good morning, Sonia. Yeah, I heard out Nigel and I think he has compiled it quite well. This quarter is good in terms of demand. We are expecting around 8% volume growth year on year. Sequential just 8% decline, which is relatively better than a normal monsoon quarter, witnessing more than 10% volume contraction. So yes, volume numbers have been better. And even on pricing front, it's the earlier base whereby, in a monsoon quarter, usually we don't see any price hike to be affected for sure. The price corrections we are looking at is close to 3% Q on Q, which is again, a decent number rather than extremely pessimistic number, given the pressure most of the areas witnessed heavy rains. The key concern has been the fuel prices, which continue to go up till mid-quarter, and thereafter petcoke prices have seen significant cool-off. Even Indonesian coal prices have come off. However, the benefit of these will only be seen Q3 onwards. So Q2 numbers for the sector as a whole, we are expecting fuel prices to be elevated by 100 to 200 rupees per ton, and with lower realization, and also because the utilization will be lower quarter on quarter, there will be further pressure on the cost sequentially. So this quarter is supposedly the worst quarter the industry is staring at. Most of the from 5 to 6 quarters back reporting the peak margins, and they are now coming down to sub 700 rupees per ton on an industry level. This is for sure one of the worst quarters the industry has seen in last many years. But as I said, with fuel prices now looking, have softened, and while there is some spurt again from the lows, if things remain stable, I believe Q3 and Q4 onwards, the industry will see margin expansion. As Nigel also rightly pointed out, the companies have rolled out price hikes, and in part, most of them are getting affected. So they will push up the margins in subsequent quarters.
Rajesh, just one second. I mean, the market, look at the market, is taken a dive. 90 points gone now on the index at 17,150. So this is at the day's low, easy at the day's low. And I think the big thing which has happened, if you can have the Nifty intraday, the big change which has happened is that the IT index has completely given up all its gains. There you go, 95 down now, almost approaching the three-digit cut mark. And the IT index has given up all its gains. Although, if you look at constituents, only two Nifty IT stocks are in the red. What's happened is everything else, I mean, Infosys, for example, the day's high was, almost 1480. It's come down to about 1464. So gains have been given up, although stocks are still not turning into the red completely, except TCS and Tech Mahindra, which are down. TCS is down almost a full 1%. So that's the big change which has happened. Just wanted to point that out. 98, 99, so sort of dropping as we speak. Nigel.
Okay, all right. Well, that's about the index. But, Rajesh, I wanted to ask you about this deal that took place yesterday, India Cements. Finally, after many, many years, I think the street has been waiting for them to do something on the debt front. And this is sort of a first of its kind announcement from the company. But they wanted more, looks like, because that 600 crores that they're going to get, it seems it's not enough. What's your view on the stock? And if you could give us a rough value, that 1.5 million ton, now our sister concern, CNBC said that they could be looking at selling that Rajasthan unit. What would be a fair valuation according to you?
So first on this deal, see, this is a good move because one of the things which the street was looking forward from India Cement was to reduce the borrowings, which is hovering north of 3,000 crore for quite long time. And given that the management have always been talking that they have a lot of non-core assets which could be hived off to reduce balance sheets, so hopefully more of them should follow. So that will obviously have a positive bearing because operationally the company is quite constrained, even though it has premium brand positioning in the southern markets. But on the cost front, this is already heavily stressed. So in that scenario, a high balance sheet is also not a very great thing India Cements is looking at. Now coming to the North Unit 3, Netra Cement, which they had amalgamated a few years back. This is from an India Cement perspective. Obviously, it doesn't hold much synergies. That 1.52 million ton company capacity. Now, while I don't have the intricate details in terms of the limestone capacities and the operational efficiencies metrics, but fair to say, even if it's a relatively older plant, most of the such acquisitions may happen between 600 to 800 crore per ton. Ideally, that is the valuation we should be looking at. So if it is a 1.5 million ton, another 1,000 crore could be garnered by the company. So if at all that goes through, that will significantly improve the balance sheet for India Cements.
Okay, all right. So that'll be interesting. The other unit that everyone's been talking about is the JP Group unit. I was going through the annual report and they have 10.5 million tons of capacity. What should be the rough valuation out there? Out here, you have told us close for 1 million tons, 600 crores. For that unit, some of them have, a backward integrated clinker. Some of them don't have. It's only grinding. So for this 10.5 million tons and around 350 megawatts of power, what should the valuation be?
So, see, as per my understanding, the clinker capacity for there are two units of clinker, and between them there are close to 4.5 to 5 million ton of clinker, or maybe 4 to 5 million ton of clinker is what my assessment is. So 4.5 million ton of clinker, and so approximately you can say that 7-8 million ton in integrated plant. Assuming these capacities are well integrated, are quite operational and in good shape because the company has been under pressure, working capital and production has been under stress for past 3-4 years. So it should get a valuation of 800 crore per million ton. At least this 5,000 crore or number 5,000 to 6,000 crore is a fair value because whoever acquires it will also have to do a lot of maintenance capex and get things up and running.
All right, we leave it at that. Thanks a lot for joining in.